All right, good afternoon, everybody. This is Event Trader here, joined by Chart Trader Brett Manning. Brett, you with us?
Yes, I sure am, Gav. How you doing?
I'm doing pretty good. Not as good as the markets, though. The markets definitely got a little bit of hubris and a little pop to the step in it this morning, right?
Yeah, right. Studying that bounce.
Yeah, exactly. So, probably good to break into a few things that we were discussing last week that we were seeing playing out, Brett, just to get us started here. And then there was a number of items out over the last week that I think caught both of our attentions in a few reports that we'll go through and try to give everybody the lay of the land. But the one thing that I would say, Brett, we were talking a lot about how well hedged people were, and how that did have the potential, if we saw things switch on the dime around trade talks, central bank policies, and the like, that there was the ability for it to rip higher, just being on how bearish everyone was set. So you want to lay out what you saw from your landscape over the last 2 days on why we're ripping up higher here?
Yeah, sure. I mean, we closed last week's show by noting that from a long-term investment standpoint, some of the indications we were seeing for what I would say, what I would call large money manager sentiment, reflected the kind of environment that tends to characterize some of the best longer-term buying opportunities. And particularly the LOBO ratio is when we focused on. It's the large only buy to open put call ratio. So for large options orders, you're generally dealing with professional money, and the skew was at a multi-year extreme in terms of puts versus calls over the course of a couple weeks. So that was a strong indicator. And then on Friday, in my notes, I talked about some information released from Bank of America in a research piece about its own private clients and their exposure. And we saw some of the same things that really confirm that. Apparently, the Bank of America private clients through the prime brokerage service were the most hedged that they've been since January 3rd. So just after the December crash and just before the big 3 to 4 month monster rally in the market. And that really matches up with the LOBO ratio. Another point that really matched up from that same research piece was that we saw the second biggest week all time in terms of flows into government bonds the week before that. So as we were coming into those lows, there's a couple of indicators there that suggest that that there's so much hedging, there's so much sidelined capital, and what I called in our show last week recession prepping. And that really creates a massive vulnerability to the upside if you do start to see any signs that we're not going to head right into recession, because you pretty much you've got a ton of money that has to rebuild exposure, and I think that's why this bounce has been so aggressive and so consistent, and kind of just plowing through levels and plowing through events, because I think it's a classic version of what I call a flat squeeze, where money comes off the sidelines, very much in the same way that buy orders happen in a short squeeze, because you're dealing with a picture that is relative to a desired level of exposure. So when you're underexposed as a professional money manager and you need to keep pace with the benchmark and you want to be able to get a bonus at the end of the year, you don't want to lose your job, you're dealing with other people's money, and you're not exposed enough and the market starts to take off, you're more or less forced to buy, at least to kind of hedge against the upside. You can almost think about it as hedging against the upside. Probably a lot of index exposure, possibly a lot of options market shifts, maybe some futures, maybe ETFs, whatever you can do to just get your level of exposure back up to something that is consonant with where your benchmark needs it to be. And I think that we saw so much hedging in place that we were really vulnerable to that. And when the market started to spring back and we started looking for 2 to 3 rate cuts by the end of the year in a situation where we're not really close to the type of data that would normally spur that sort of move by the Fed, then I think you get people who are worried about a repeat of the late 1990s, and I know that's something you wanted to talk about as well. Because if you get into a bubble and you're flat and you're a money manager, then you're out of a career.
Yeah, and I think building off that LOBO, I think that's one of the more interesting aspects that I was seeing from some of the sentiment data, Brett, where we saw it bit of a dive out from the excessive pessimistic levels for the LOBO ratio reading down into a little bit more of a middle area for it. So certainly a pullback there. But it seemed like a lot of the LOBO sellers that were selling the puts were selling it to the ROBO buyers, the retail option buyers there, because we did see a spike up in that area into the excessive pessimism level. So certainly seems like that's a pretty clear case of the dumb money chasing the smart money in terms of where the options trading was going.
Yeah, well, and it's another way to look at it is retail traders are fading this bounce. And, I mean, because we're spiking up in the ROBO ratio along with the market spiking up and along with ROBO dropping down. So, yeah, you're seeing the larger money managers shift their use of the options market to aid their positioning. And that's fueling the market higher, and retail traders are becoming more bearish into the bounce, which usually is something that makes the bounce more sustainable. And another one of those points is
just adding the kindling to the sideways squeeze, basically.
Well, to the fact
that how you'd view it?
Yeah, I mean, you could see a lateral range type of consolidation out of this. It looks like maybe we've topped that initial leg of the bounce. Maybe we work back to, say, 2850 in the S&P and then form a range, and then it's the move that follows that could really start to put the squeeze on, depending on, I mean, obviously world events have cast such a big shadow over things, but there's just a biasing factor that comes in when you see the ROBO ratio actually show retail traders becoming more bearish as the market climbs. That's been something that's a relatively consistent predictor that it's going to be a difficult to fade bounce. Another one would be that the VIX is not really dropping very sharply on a day like today, and what we saw on Friday. You really didn't see a lot of that side of the market heal that dramatically, certainly not as fast as the market has ripped higher. Now, it has been a volatile bounce, but it's another one of those factors where you see maybe that it's a little more difficult for the market to sharply pull back when people are positioned the way that they are and when those indicators don't shift very quickly.
Brett, since you mentioned the VIX, there's a feedback question I was going to toss your way since you got a pretty fair idea of what's going on here. But the sub was asking our opinion on why the VIX is not dropping Friday and Monday. The sub said that they shorted the UVXY, and this trade correlates 95% of the time to work if the SPX goes up. But they're flat from Thursday's close, which is highly unusual with a 29 handle move on Friday and 26 more today. You got any thoughts on that question?
Well, I mean, I would say that that people are not giving up on the idea that we've got volatility ahead despite the bounce. I mean, in very simple terms, that is clearly what's happening. And, I got to tell you, one of the really interesting things that we saw toward the end of the late 1990s was a steady rise in the VIX from about 1997 through the 2000 highs, which was kind of interesting. And really from late 2006, early 2007, we saw the VIX gradually rise, even though the market was making new highs. So at the tail end of a cycle, at least in the past couple cycles, we've seen the VIX reluctant to give back ground after moments of volatility, and perhaps that's because people underneath the surface, particularly on the professional side, see signs that are troubling underneath the surface and are unwilling to give up on the idea of pricing volatility over the coming year in the market. And but it is also, just as I said, it's another sign like the rising robo that we're keeping a wall of worry feel to things right now as the market climbs, which usually makes it a little bit tougher to capitalize on those shorts. In contrast to, for example, what we saw and what we took tremendous advantage of in middle to late November, when we saw some of the G20 stuff. Then we got some headlines. We had some volatility toward the end of October and into November. We got a couple sharp bounces, and in those cases, we saw just the opposite. We saw an immediate surge in bullishness, and that really kind of gave away the idea that you could fade those bounces rather easily, and that we might be able to bust the lows when we went down through it. And this is kind of standing in stark contrast to that so far as it evolves.
Okay. So you mentioned a lot about, and just one thing to add on the robo, 25% of the option volume was buying protective put options, which is one of the heaviest amounts in that trade since the financial crisis. So it kind of builds upon what Brett's talking about in terms of people trying to fade this rally and the extreme pessimism that's out there right now on the retail side that we've seen the LOBO move away from. But Brett, you mentioned a lot of similarities between this current environment and from back in the late 90s. And I think it's important that we discuss the central bank, the Fed in particular here. We'll get into a few of the other ones and discuss the central bank strategy. But certainly a lot of parallels are being made to 1995, and that's why I thought it was interesting with how you're discussing the VIX there. I know it's still way too early, but for those unaware, in 1995 we had basically what was called an insurance put, which a Greenspan-led Fed would go on to cut basis points 75, or to cut rates 75 basis points in three rate cuts over the course of time. And this was basically to head off a downfall in the economy. There was a bit of a concern about, or there was no concern about inflation, similar to what we have now. And the Fed felt that they were in a position where they could assist the growth by lowering these rates. So this was in 95, and it's funny when you look at a chart, then you start seeing that internet bubble really start taking off, and basically was more or less a Fed misstep on this that led to the bubble in the internet, a lot of easier borrowing and excessive loans being made to internet companies in the venture capital area. So Brett, with this potential for 3 rate cuts coming in this year, I still not buying into that, but the Fed funds futures are definitely pricing in 2 at the moment. You seen a lot of similarities between 95 and right now?
One could make that comparison. I almost think the late 1990s comparison is a little bit better for me, but yeah, I mean, either way, you've got this idea that the Fed is, or at least central banks in general, I think around the world, are much more fluid after the 2008 global financial crisis, it would appear, in being very proactive about using policy to attempt to maintain their preferred levels of a number of different indicators. And back in the 1990s, there wasn't quite as much of, I think, a sense of almost engineering the economy using central banks. But definitely the lever was pulled in 95, just like it was following the LTCM Asian currency crisis. And in each case, you could see it as having been sort of preemptive. And the interesting thing is in 95, it wasn't really in response to even stock market weakness. In 1998, one could make the case that, you know, the type of volatility that spiked up then, I think the VIX got above 45 or 50 or something.
Exposure to LTCM obviously was playing a factor there.
Yeah, I mean, that there were cases made, and if you look at some of the, I can't remember the name of the book. There was a spectacular book written about that period. I'll think of it at some point. But really, I got to think of that book. I'll post it to the page later. But the idea that some of the behind closed doors meetings that happened, there was a lot of pressure being put on by some of the biggest players on Wall Street on the central bank, basically saying, you know, that there's too much tied in with LTCM and that they were tied into too many different currency systems, and that, you know, the whole global financial system will come crashing down unless the central bank shows up and says, we've got your back. And, you know, that turned out to be what many people at this point consider to be a policy error that sparked a complete blow-off bubble, which then roped in an enormous amount of the economy into a highly vulnerable positioning situation, fueling unreal assets, essentially, a lot of complete fluff. And you had a lot of people's 401ks tied into it, and when that bubble popped, it ended up being tremendously damaging. And one could say that that's how we ended the last real cycle in a lot of ways in the economy until this one, because really we got a bear market and a recession, and then we got what I would consider to be almost a false cycle, at least in the United States, from 2003 to 2007. Just sort of a financially engineered cycle and then a credit bubble burst. And you could look at them all being a little bit linked together as one consolidative process that started in 2000 and ended in sometime maybe 2010, and then we have moved into another period. We're in a new cycle at this point. And a lot of people might say that it was the way that the Fed really fueled that bubble that maybe set in motion a process that was so destructive over the course of such a long period. So there's been cases like that made, and the question is, are we going to be saying the same thing in 5 years? I doubt it, but one could look at this being a similar situation where the Fed probably might be a little bit too proactive by cutting here. And I think Goldman Sachs just came out this morning and made kind of a similar case, and that they're believing that the Fed is actually going to shrug it off and end up not cutting because they're going to be worried about that type of situation, and maybe worried a little bit. I mean, one of the things that I think is pretty obvious is since we got the bounce last week, the White House has started to really step up pressure on the Fed to cut, because maybe they're kind of seeing, hey, this could be a situation where now the Fed feels like it's off the hook. It doesn't need to cut, but the White House really wants the Fed to make that move. So as the stock market closes back in on all-time highs, it gets tougher and tougher perhaps for the members of the Fed to sell it to each other that they really need to be cutting rates right now. But I think the yield curve is, if they want to justify it, is how they do it.
Yeah, certainly opens up for that. We, of course, have the Fed next week, and not looking for them to cut rates in it, but I guess we could take a quick peek ahead, Brett. For me, if they're going to cut in July, I think that they have to be pretty dovish with their outlooks. They're going to be updating their projections. Is there anything special that you're looking for? Obviously, the Fed's in a quiet period until then, so we're kind of at a guessing game for the markets until next Wednesday. But is there anything you'll be looking out in particular for in this Fed meeting?
By the way, that book was When Genius Failed by Roger Lowenstein. So there's it's spectacular. Somebody wrote it into feedback. It really is a great read. But sorry, so what am I looking for from the Fed?
Yeah.
At the June meeting, I'm looking for them
a quick early look.
I'm looking for them to introduce the latitude in their language to cut rates, and I feel like this is so obviously the Fed funds futures, the way that they're straddling expectations around June to July around the G20 meeting is painfully clear what the justification will be if they do cut in July. They're leaving open the possibility that a meeting between Xi and Trump could somehow yield a new phase of this negotiation process whereby we start to get back into what we felt earlier this year, that we were on some kind of inevitable and inexorable path to a deal of some kind, and it was just working out the details. And it's not impossible, I suppose, that coming out of G20, there could be, there's certainly not going to be a deal announced at G20, but there could be one of those White House press releases that have become so notorious about, claiming that the deal's in place, but really that it's setting in motion a process whereby, maybe over the course of 60 or 90 days, there will be a lot more intensification of important meetings, and we get back on that feeling that we're on a path to some kind of legitimate deal that's going to stick. And I think that if the Fed were to see that, it's possible the cut would come off in July. And I think that there's no way they would make a move ahead of that possibility in June.
Right, I agree. Now, central banks have been pretty busy here the last couple of sessions. We, of course, had the ECB announcing their TLTRO rates. Now, for me, it struck me as being a little less than what people were looking for. I know you were reading a comment saying that it was above the expectations there. So I don't know, a little bit of a mixed sentiment on where the ECB did, but I would note that the euro was a little stronger since then. So I don't know if that's as much the ECB or as much the Fed, but also the Reserve Bank of Australia and India cutting rates, and starting to see a little bit of a discussion of I wouldn't call it a Shanghai Accord, but certainly a group G20 central bank convergence. Are you seeing anything along those lines, Brett?
I mean, let's take a look at what always becomes the narrative in my mind, if I'm writing let's say I'm a novelist and I'm writing this period in history about what goes on behind closed doors and phone calls between central bankers, I think that the number one thing that has to kind of transpire there is about the problem if there was a sustained and expanding divergence between the United States and the rest of the world, because the dollar is the reserve currency, and how that just wreaks such havoc on everybody. And I think that whenever you get this feeling that there's a lot of coordinated action, I mean, we've had 9 central banks cut rates, and we've got talk now. The ECB has clearly paved the way. It's put out those trial balloons.
Talks that they could cut rates too.
Yeah. Oh no. Right.
Negative territory.
Yeah. Exactly. So you're going to push that thing down even further. And then, of course, the Fed coming in, and the Fed, that if you want to come up with a justification for why Goldman Sachs may be wrong in saying that the Fed is going to avoid that cut, it's probably those conversations. Because if the United States is able to continue to expand and we start to see inflation snap back and everybody else around the world is doing what they're doing, then the divergence just wreaks havoc on everything. And I think that it's almost like maybe a lot of the rest of the world would really be lobbying for the Fed to cut, along with Donald Trump, because it kind of pulls things more into alignment. And if you just were to take a look at the United States, you see that the stock market, what if we're back at all-time highs by July? We don't have a trade deal, but we're back up there. Positioning just pushes us back up there. And the Fed is forced with that situation where they're looking at reasonably okay economic data and a stock market at all-time highs, and they're cutting interest rates. It's not a great look, but if you look at it in context with the sort of tide of global central banking, then it becomes more justifiable. And particularly, I think the place that shows up the most obviously is in the United States yield curve, and how it's really becoming, I believe, because I think currency volatility has been low enough that we would suggest that the forward rates on hedges for taking advantage of that with foreign money are probably slight enough that there's just a tremendous amount of fungibility right now. And I think that you've got Germany pushing rates down where they are. In that context, the United States, the long end of the curve, is just going to be clobbered. So I think that it's that misalignment between the Fed and the U.S. internal economy and what we're seeing in a lot of the other major industrialized nations around the world that is forcing a yield curve shift for us that I suppose starts to become a problem for the United States big banks if it were to stay that way without the Fed taking action. It's kind of, I think that they become unprofitable, right, if the Fed doesn't move.
Yeah. I mean, that's certainly a possibility if it's for an extended period of time. We've been dealing with pretty tight spreads the last couple of years now, and just seen, I was reading J.P. Morgan's the second most profitable company in the United States, just behind Google. So, they had $32 billion in net income last year. So they're still doing okay, even with these tighter spreads. That's for sure. I think it's a little bit of a misnomer that banks automatically will go unprofitable if there's an inverted yield curve, certainly for an extended period of time.
So that makes it tougher, though, and you have to have a platform built to be able to handle that.
Sure. No, it definitely makes it tougher, and that's why the J.P. Morgan returns have been so interesting, being able to get 17% ROE on a quarterly basis in this rate environment. Certainly,
there's got to be big losers, though, too. I mean, J.P. Morgan's probably the best case scenario there, and there's got to be banks that aren't built that way, and net interest margins that start to turn negative just mean.
Yeah, I mean they're definitely among the highest, and their net interest rate runs around 2.72. I think so. That's just the return on equity, but of course they also have the investor bank. But the majority of their net income does come from the consumer side of things. But yeah, for a longer term period, an inverted yield curve is certainly not a positive for the banks, and that's something I'll be looking at. And of course, it's always interesting to keep a look at the European institutions, which have just been getting killed by these Fed funds rate. But I think that's why that Teltros were put into place and geared a little bit more towards the banks that are using it aggressively to get a little bit better rates.
But let's circle back around here. So if we have large money managers overly hedged into the lows, if we've got retail traders that have been fighting this bounce, and if we have a situation where the Fed, according to our domestic economic data, maybe doesn't want to cut, but is put in a position by its relationship with the rest of the world and its relationship with the yield curve that we have right now, where it more or less has to, in a situation where companies are still doing well and the stock market's near all-time highs. That sounds to me, that just on its face, that sounds to me like a bubble recipe for the stock market.
It definitely has a bubble recipe for the stock market, I think. The key thing for me, of course, is I'm still curious to see this Q2 earnings season and if this economic data continues to tail off. Because, I mean, if this is I think you can't get a bubble if you don't get a trade deal between China and the U.S.
That's just politics.
That's politics, and that can switch on a dime, especially.
And it doesn't mean that we're talking about the requirements of a trade deal with China might not be that hard. The idea that we're solving all of our long-term, geopolitical strategic relationship with China is obviously farcical and ridiculous. But the possibility that we were to get some piece of paper with words on it that people signed is not. It may be what the market requires, even though really, it's going to be easy for people to write books 10 years later about how that really changed nothing in terms of the trajectory of the two nations and how they were just going to continue to bump up against each other.
Right, and I mean, there's definitely that recipe for it, because we've been talking a lot about how a lot of the issues that we're looking at were man-made, and if that gets reversed, then central banks can certainly get caught leaning offside. Somebody postulated to me, what if Trump's the biggest genius ever and just kind of started doing this with the idea that he would get the central banks so scared that they had to cut rates, and then he would flip back to the other side. So it's a nice
job of painting a narrative, yes.
It's really going to be interesting to see how this plays out. But I mean, there's without a doubt central banks are certainly seeing a little bit of a coordinated effort. Similar, I don't think it's to weaken the dollar like it was back for the Shanghai Accord, but certainly, as you were saying, Brett, to try to ease some of the pressure on those interest rate yields, that could definitely be in play here.
Sure.
So, all right. So, we talked a little bit about the central banks here. We talked about the LOBO and ROBO positioning. Brett, was there anything from the sentiment trader that was jumping out to you in addition to the LOBO ROBO?
No, I don't think particularly. I think that, but I mean that's sufficient. I mean the AAII data has kind of got the same sort of feel to it a little bit. I mean you have a situation where there's nothing that's really arguing with the idea that the professional side of the market became overly hedged and underexposed during the course of the fallout from the China trade deal we all thought we had in place falling apart completely. The fallout of that was, I think, unquestionably the buildup of a huge problem of underexposure. And I think that it came from levels where you already had kind of tepid exposure. So you really have a situation now where if we get into a different kind of environment, and one of the other little factors here, I think it's picking up steam a little bit, and I don't know how much there is to it, but I'm just seeing a lot more right now about a very well-funded, very strong attempt by essentially something you might think of as like a union of corporations in America, and you can call it the Chamber of Commerce, but you can call it maybe just a lot of phone calls too, of getting an effort to try to get a bill, a veto-proof bill through Congress that takes tariff power away from the presidency without some kind of congressional approval. And I would have to think that if that got a little bit of momentum, that could have an enormous impact on the market. And it would be one of those factors that could bring that professional money 100% back in.
I'd be curious to check the legalities that need to get passed, because from my understanding, it's unless the president signs off on it, it's never going to pass. And we know there's no way Trump's going to give up his favorite new toy. So.
Right, but I wonder what he might exchange it for. You think there's
$2 trillion infrastructure bill, which would
who knows, right? I mean, if you could find a way to get, there's almost the most important negotiation that could go on over the next year. But I mean, I think that what that could do for professional money participation in the stock market is probably just crazy.
Yeah, it certainly sets up a further of that bubble that we were just talking about. But yeah, I mean, really with the smart money kind of unloading their options onto the retail side of things, it's just adding onto that kindling right here. So certainly tough to fade this market as we've been seeing over the last couple of sessions. So curious to see how this continues to play out. Of course, we still have plenty of headline risk going forward with the G20. The Fed perhaps not getting as dovish as some people would hope. So there's a number of things to continue to watch here. But one thing I wanted to ask you about too, Brett, is gold, where I know you're in that gold trade. It's down a little bit today, still well up in your position there. But I was looking at that option hedgers. The long contracts dropped from more than 30% of all open interest to 27%. Is that anything you're interested in on your gold trade, or are you just kind of viewing that as some hedgers around the Mexico tariffs just are unloading their position, but there's still plenty of potential buyers out there on a worldwide easing on the central bank side of things?
Yeah, I mean, the way that I look at gold futures exposure data, right now, we're at, I look at the large speculators, most importantly, we're at 156,000 net long. That's where we were before the entire last major gold bull market from 2005 to 2013. So that's a beginning point. It can get up to twice that relatively easily. So there's plenty of, in terms of the relationship between, how much speculative exposure is in gold right now and where it tends to get to when it's at an extreme historically, there can be a ton of money still pouring into gold. This is relatively middling and neutral as far as positioning is concerned. So there's nothing to prevent the big spiking breakout of that multi-year ascending triangle. Obviously, we're going to be pulling back on a day like today when you see that sort of shift, and I would call it kind of coming back from the precipice that we were at, a week ago, basically, in terms of people thinking, hey, we're going to see this implosion in our relationship with our trading partners, and at the same time, the beginning signs of a recession and all sorts of stuff, and money just, the same thing that happened with the treasury market happened to some extent with gold. It's still, on a larger time frame, it's positioned well, but as I said earlier, we had our second biggest week in history in government bond inflows a couple weeks ago. So there's that kind of side of the gold market for sure. I think that it still kind of has the same overall technical setup, and it still kind of has the same narrative around it, which is sort of a just-in-case spot for exposure, given the sort of situation we would see on cycle rollover, given how difficult it would be in theory, purely hypothetically, if we were to move into recession with a situation where we can only get a couple cuts out of the Fed, and we really can't do anything fiscally. And we're just going to be kind of, trying to figure out how to come up with something brand new. And brand new when it comes to monetary policy is a scary idea.
Yeah, policy impotence definitely seems to be one of the bigger fears going on around this.
I think policy impotence.
We've seen it in the ECB and we've seen it in the Bank of Japan.
Well, policy impetus is part of it, but it's what comes out of that, which is policy creativity, that I think drives money into gold in a lot of cases. Just simply, we don't know. You're just going to have to figure it out, and we saw a lot of that from 2009 to 2013 when we had the huge bubble. That was the process. It was wrong. I mean, it was, in a way, you could look at that as just having been wrong. It was wrong in a way that you made a lot of money on if you were wrong, like a lot of other people, about what was happening there. And that idea was that we're printing money, therefore there will be hyperinflation or something along those lines. And that was a completely wrong idea, but I think that really does explain the majority of that move in gold that has subsequently been mostly given right back. So there was a bit of a gold bubble. It was sparked by quantitative easing. It was sparked by policy creativity because we didn't know how to deal with the situation we had. Interest rates were very low and then went down to zero, and then we tried to figure out something else to do, and money flew into gold because there's all sorts of stuff that could go wrong in that situation, and it's just a place to park. And it turned out to be a massive bull market for gold just on that. So I guess it's kind of the similar situation. I think that we would be faced with another moment of policy impotence leading to policy creativity, leading to people not really wanting to have all their eggs in any basket and some eggs in gold. So that's the big broad outlines of it. But again, we're stepping back from the precipice right now, and there's every possibility that we go into an equity bubble. And I would think an equity bubble would probably not be good for gold, but I have no intentions of giving up on the position just based on that theory. It's still got this large multi-year ascending triangle pattern in place, and I am invested in the equity market, so I'm pretty comfortable with where I am.
All right, and then I guess we'll just touch upon the dollar here and what you're going to be looking at going forward. Obviously, coming back, it's pulled back from that 98 area here, trading right around 96.76, just above the 50 and 200-day moving average. It's been trading a relatively tight range now for since September. When you're looking at it weekly, and I should say that's weekly 200-day and 50 moving averages there. Anything in particular you are looking for in the dollar moving forward here, Brett, as a read for the markets?
I mean, it's kind of a little bit. I mean, obviously, we had a situation where, and I really do key off the euro to think about this. It's over 60% of the index, and it just kind of it's such a central idea in terms of the other side of what you see in the dollar. And we had the idea that the euro was rolling over in an accelerating decline, and people were massively positioned for that, and people were massively positioned for the other side of that, which was the dollar kind of going into an accelerating, almost parabolic breakout to the upside. That's the divergence idea we were talking about. It's the thing that gets the central bankers on the phone with each other. It's the big nightmare scenario because while it doesn't necessarily mean that there has to be something terrible that happens for the United States, there's unquestionably going to be lots of terrible things happening to everybody around the world who's holding dollar-denominated debt and can't, you got a liquidity crisis then. And, that's the job. Central banks are going to make sure that they stop that. You've seen strange moves over the last 10 years a number of times when that's got started, and you've heard about different swap deals the Fed is making with different countries to try and alleviate the complications that causes. So you've got people positioned that way, you've got that conundrum set up, and now suddenly we go from, just like you said in December, we were looking for 3 hikes, and now suddenly we're looking for 3 cuts from the Fed. And I think that, the positioning situation around short euro, long dollar got to relatively extreme levels, and we're starting to come back off of that as we see convergence now in terms of policy, and a Fed that looks like no matter what, they're dedicated to creating some more convergence. And we'll see if Goldman Sachs is right and that idea goes away because the market's back up. And I think that's one of the most important narratives that we're going to be tracing, particularly next week with the Fed, and then in the July meeting. It's really going to be a driving factor to try to understand and unearth the degree to which this is really the Fed kind of almost with a forced hand to cut because of the fungibility of the yield curve and because of where policy's gone around the world.
All right. Brett, anything that we haven't touched upon that you wanted to discuss?
No, I think we were pretty comprehensive.
Yeah. So obviously, if there's any questions from anybody out there, by all means, feel free to write in. We'll follow up with it. But, we'll be keeping an eye on things this week, obviously. Certainly that inflation data will be of particular interest with the PPI, CPI, and import-export prices. But it should be a generally quiet week. We'll watch the headlines and provide the updates, and also any sort of moves that we're seeing in the hedging market. But certainly looks like, I think the key takeaway would be it's going to be difficult to fade this rally here given some of the positioning that we've seen, right, Brett?
Yeah, I mean, that's what it would appear so far. The evolution of the data suggests that people are still in a protective shell. And I mean, obviously, this is a headline-driven market, and we could see headlines that make that idea look ludicrous because suddenly, we have a massive flare-up, and where we've just decided to, we get the next tweet about tariffs on Canada in an hour, and
right. Yeah, but I'm kind of leaning that at this point of trying to buy dips here for the next couple of sessions at least anyway.
Yeah, I'd like to see a lateral range consolidation and maintain this data and then look for breakouts. But yeah, I mean, same thing would be better positioned if you were able to time that dip.
Okay. All right. Well, Brett, thanks as per usual, and look forward to meeting up with you again next week and discussing all what we're seeing online there because it's definitely an interesting market.
Very much so. Yeah. Thanks, Gav.
Okay. Take care.
You too.